Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, we will be talking about ETFs with my guest, Adam Patti. He is the CEO of Index IQ. Adam, thanks very much. Thank you. Thank you very much. Index IQ. Tell us a little bit about your company and what you do.
Great, thanks. We got started in 2006 to democratize alternative investing. And what that means is we wanted to apply index-based methodologies to the more sophisticated institutional class investment strategies that really weren't available to most investors. I mean, why should the largest institutions in the ultra high net worth have access to the best strategies? So we got started, and long story short, our products come in three categories, generally all liquid alternative strategies. One is absolute return products, include our hedge fund replication strategies, which we're the leader in the world actually in those types of products. Real assets, commodities and real estate and so forth. And then our unique international exposures, including small and mid cap strategies.
So how have you seen, you started in 2006, you said, the acceptance of these products. Has it been, a welcome acceptance, a broad acceptance of this?
Absolutely, absolutely. I mean, it took about 2.5 years to actually launch our first ETF. So our first ETF launched in March 2009. And since then, we've been out educating advisors. We're still a small company, but our products are really all about education. And it's important to go out and tell advisors not only what our products are, but how they're built and how they work in your portfolio.
So tell us a little bit about the hedge fund ETFs that you have. They're based on a hedge fund index, correct? An index that you created in-house?
Yes, that's right. These are really exciting products, and really, I believe these products have the opportunity to kind of reshape the entire investment management industry, just like Vanguard did in the 1970s. The reason for this is because the hedge fund marketplace now looks so much like the mutual fund market. There's 10,000 hedge funds, there's 10,000 active manager or 10,000 mutual funds. And what we all know is that about 85% of active managers underperform their benchmark. So why wouldn't that apply also in the hedge fund marketplace? The academics proved in the 90s that actually hedge fund performance is comprised of a lot of beta, not necessarily S&P 500 beta, right, but other more diversified stream of risk premia across different asset classes. And that you can replicate hedge fund performance using liquid securities by identifying those asset class exposures and capturing them in a portfolio. And that's what we do. So our indexes, which we created, have been live with Standard & Poor's. They've been calculating with them since March 2007. And those form the basis of our products, which are designed to improve diversification in investor portfolios.
Interesting. So it's an ETF, it trades like a stock, and it affords a small investor the opportunity to participate in a hedge fund kind of correlated investment, which they did not have the opportunity to do before. Traditionally, you'd have to be a high net worth individual, maybe a few $1 million or at least $500,000 to put into a hedge fund. Now the small guy has a chance to sort of track what other hedge fund managers are doing with this index.
That's absolutely right. Small guy or large guy, because here's the thing. Why invest in these 2 and 20 hedge funds when you can get 90% or so of the performance benefits of the better hedge funds in a 75 basis point ETF that's fully transparent and fully liquid? So while smaller, less sophisticated investors are using our products as their entire kind of hedge fund exposure in their alternative sleeve of their portfolio, more sophisticated investors are using these products as the core and a core satellite. So we give you that cheap core alternative beta that you're looking for, and then you go out and you find those alpha managers for satellite positions. And this goes for our product, QAI is one of them, which is an ETF. MCRO is our market directional ETF as well, or M&A is our merger arbitrage version.
And you could look at these as a proxy for hedge fund manager performance, right? I mean, if you look at your stock, your ETF, you kind of can get a gist of how the hedge fund universe community is doing, right?
Absolutely. In fact, we have started, because we've gotten a lot of inquiries on licensing our underlying indexes out as the form. Are
they outperforming or underperforming the market?
They are the market. They are the market. They are the market. So if you track our hedge fund replication indexes versus all the other kind of non-investable hedge fund proxies out there, we're smack right in the middle of all of them. Right there, exactly, which is where we should be. And we want to be the market. We want to be the S&P 500 of the hedge fund market.
Oh, it sounds fascinating. And I know you came out recently with a new ETF. It's a different space, a different area. This is the emerging market mid cap ETF. Tell us a little bit about that one.
Yeah, I'm really excited about this one. We just launched this yesterday. I mean, it's time to get back into emerging markets. They've been drawing down for 9 or 10 months. They've been out of favor. A lot of that's because of the inflation expectations for that part of the world and the commodity prices and oil prices that have been going up. But a lot of that has subsided. Inflation risks aren't as dire as they were. So we launched EMER, which is the ticker for our mid-cap product, yesterday. The reason why we launched this is because mid-caps outperform large and small caps historically over the past 30 years. That's a fact. And they've done so with lower volatility than the small caps and just a little bit more volatility than the large caps.
Right.
So the Sharpe ratio of mid-caps is just higher than large and small. There's never been an opportunity for emerging markets investors to get access to those mid-cap stocks, which, by the way, are more representative of those emerging market countries, because when you buy...
What countries are in that,
Yep, we've got 20 countries represented. The largest is Taiwan, and then South Korea and South Africa are the top 3.
Okay.
So it's very broad, just like you would expect for an emerging markets product. But what you're getting is
You don't have the BRIC countries like the Brazils, the Russias?
We do.
They're in
Absolutely.
there.
They're all right in there.
Okay.
Just like EEM, which is large cap, or VWO, those are large cap. Same countries represented, just a different mix on the countries as well as the sectors, because mid caps are really more representative of the home country. They're also cheaper. And we think a good opportunity to play.
So it's interesting because now, again, the investor has the ability to diversify not only internationally and in sectors, but also in capitalization. You've got the full range now. From a small cap, you have a small cap emerging market ETF. You've got the mid cap, and now, of course, you have the large caps as well.
Exactly. And the reason for that is important because investors traditionally have invested in international emerging markets for diversification, but now all those large cap products out there are correlating very highly to the U.S. market because they're basically exporters that are plays on developed markets. So if you want diversification, you got to go for the mid and small cap, and that's why we focus there.
Okay, and I know you have the commodity raw material ETFs as well. What is how do you find people's interest in that? I mean, that's been a very, very hot area. Is it still a very hot area?
It is very well. It's been less hot over the last couple of months, but what is hot, which I wouldn't say is commodity, obviously, but in that real asset space, is real estate. We did launch a small cap REIT product with a 5% yield, which is valued at a 30% discount to the large cap REIT ETFs out there. It's a small cap REITs. Again, same premise.
What type of real estate do they invest in?
All across the board. So
it could be commercial, it could be residential.
Absolutely. You got hospitals, you've got mortgage servicers, the ones that buy the mortgage debt.
Right.
Same sector allocations, but in different different weightings than the large cap REITs. But in terms of your original question, the commodities, I think agribusiness is still a great place to be. We have a small cap, CROP is the ticker there, and ROOF is the real estate one that I mentioned. But we like small caps there as well because, again, for the same reasons, they're underrepresented in investor portfolios and pure plays on the theme.
Now let's look a little bit about the macro picture. I mean, there's been an explosion in ETFs, many in alternative investment areas, commodities, et cetera. Is the space getting too overdone? Is it an indication maybe that the whole entire theme, this theme of commodities, raw materials, maybe is a little bit overdone?
Well, I think the fundamentals in the commodity market have not changed. I mean, there's a growing population. There are significant supply concerns, whether it's in food and corn and wheat and things like that, or oil. So I think the dynamics in the commodity markets haven't changed. Whether they get overblown in the short term based on market sentiment, I mean, clearly they do.
But what about with the ETFs specifically? Mm-hmm. Are some of these maybe not faddish a little bit?
Oh, absolutely they are. Absolutely. And I think investors really need to look under the hood at what they're buying because many times the ETF will sound like something and all of a sudden, you get a K1 and, you don't expect a K1 or you're getting 80% energy when you think you're getting diversified commodity exposure.
So a rule of thumb, for example, if an investor wants to consider some of these alternative ETFs, what should they look at?
Oh, you should always look for index IQ ETFs. That's number one.
Without saying.
No, but look, I mean, the first thing you got to do is look under the hood. You got to look at the portfolio and understand what you're getting, because two products that might sound the same aren't necessarily all the same, and they'll give you very different performance patterns. So you really need to look under the hood, and then you got to look at the structure. Just because you think it's an ETF doesn't mean it's an ETF or a fund, exchange traded fund. It could be an ETN, which is a note, or ETP, which is could be a 33 Act product that gives you a K1. So you really need to understand exactly what you're investing in, and that's an education process.
It is, but definitely you see a lot more available to investors nowadays through these products. I want to thank you very much. I want to thank my guest, Adam Patti, CEO of Index IQ. This is Mike Norman signing off for now. We'll see you next time. Thank you very much.
Thank you.